So we have a few questions on the chat box. Maybe Prashant, I'll ask you the first question. There are a couple of them along similar lines. Essentially, from an investor's perspective, if they had to invest or choose between investing in the White Oak FlexiCare Mutual Fund or the Pioneers PMS, how would they, what should they choose, and how is their positioning different? If you can please help clarify.
I think we get the question on every session, as obviously new participants join the call, which is very great to see. So as I have outlined earlier in the calls as well, we expect both the Flexi Fund as well as the Pioneers to do well. Now, there is a difference that the Flexi Pioneers is, or the Pioneer equity is more HNI strategy, meaning it is offered to PMS, AIF, kind of 50 lakhs and plus. Whereas in the MF, everyone can invest, even smaller investors. Generally speaking, MFs have to be a little bit more risk aware or risk mitigation tools they have to deploy. So they do tend to be somewhat closer to the benchmark, not just at White Oak, I would say across board compared to the PMS. Now, in years like 22, when benchmark does very well. So in a year like 22, when the benchmark does extremely well compared to most of the PMSs, right, over here. In that year, 9 out of 10 times, I have not looked at, but I can be very sure in years like this, MF in general, all mutual funds in the, not each and every, but the average mutual fund would do better than the average PMS. So you'll find a lot of PMSs doing better, a lot of MFs doing better than the PMS. And similarly, a team, same team, if it were to run an MF as well as a PMS or research team is common, you'll find the same thing. If they're doing what they're expected to do, then in a year like 22, MF would do better than a PMS. Similarly, for the average, not necessarily I'm saying for our case, because there are competing factors at play, but like the governance is an important factor as well. But a lot of PMSs have a lot more mid and small caps. So in years like 2018, when mid and small caps do very poorly, you would likely see mutual funds do better than PMS, because mutual funds will be more closer to the benchmark. So the same would be true for us. There'll be certain years where the MF would do better, particularly if it's a strong year for benchmark relative to the PMSs, and vice versa. If a lot of PMSs do well, like in a year like 21, quite possibly PMS would do better than MF, or a year like 2020. So it is to summarize, the MF has greater awareness of the benchmark. As a very specific example, I believe our MF fund still continues to own Reliance Industries. They cannot be 8% underweight or 9% underweight Reliance Industries, whereas PMS does not own Reliance Industries. So in a PMS strategy, that kind of a 8%, 9% underweight risk, even if Reliance rallies, PMS would have a headwind, but that risk is tolerable. And you'll find a lot of PMSs don't own such large cap names as Reliance or HDFC or other names. Yeah, we do own HDFC Bank, but I'm saying other funds may not own in PMS those names. But if you find in MFs, in most MFs, you will find these names at least underweight, but you will still find these names because they are more benchmark aware. And if you are closer to the benchmark, then years when benchmark does very well, you will again be closer to the benchmark and do better than most others. So I hope I've explained there's no such answer. I personally don't have a favorite between PMS or MF. Certain years one would do better, other years other would do better. If an individual's risk appetite is less, for a alpha volatility, then it may be better to consider the MF. And not just for us, but for anyone. In the industry, PMS is likely to be more volatile in alpha. As you can see in this graph, this whoever is this portfolio 9 was at the bottom at the top in 2017, at the bottom of 2018, somewhere in the middle, then at the top, still top, and then at the bottom 122. So PMSs can be, we are in a way the most consistent amongst the PMS group, being, as I highlighted earlier, average or above average in each of this time period. But with MFs, you would find even more consistency, or closer, the range of outcomes would be narrower around the benchmark.
Thank you, Prashant. Just another question for you, Prashant, before I go to Manoj, is given that the government-owned companies are showing strong profitability, do you see any structural change in them in a way that White Oak Strategy can start allocating to them?
Yeah, so see, we may allocate from time to time from a risk mitigation perspective, but our belief remains the same, that as an alpha opportunity, these are low alpha segments of the market. Let's look at this chart. So there have been several years when the government-owned entities have done well, or let's say government and poor governance, because we don't have just for the governments. Yeah. Like here in 2016, in 21 and 22 have been two back-to-back years. So this is a graph of HDFC Bank versus PSU Bank. So not the entire government sector versus the market, but just the top private sector company versus the Nifty PSU index. Now, 3 years in a row, PSU banks outperformed HDFC Bank. Yeah, this is the difference. So what we've shown here is HDFC Bank's performance compared to PSU. Cumulative HDFC has delivered 842, cumulative 33, and annualized alpha 14.5. But it hasn't come in a straight line. There was a 3-year period, 2007, 8, 9, where the government-owned banks outperformed HDFC Bank and possibly most of the private sector banks. Now, one could have said, and if you go back prior time period, 03, 04, 05, you would find such, again, time periods as well. And could have, I'm sure at that time also people believed it's structural now, for whatever reason. Private sector is going to struggle, or PSUs are going to have the government backing, because that was a time there was a lot of uncertainty around the global financial crisis. So the belief was that the government-owned banks have the government backing, so they would not go bankrupt. There's private sectors, who knows? Yeah. So at the end of 09, one would have been very susceptible. As I was sharing with the countries also, at the end of 010, everyone believed US was going to the dogs. But then next 10 years, US ended up being the best. And at the end of 2010, everyone was very gung-ho on emerging markets because they were going to be the new growth engines. All the developed worlds were in problem. Yeah. But the next 10 years, EM was the worst place to be. So same way, investors, not only I'm saying retail investors, but even fund managers do ask this question, and analysts do, often get swayed that now it's the new era. Remember, just 2 years ago, or in 21, everyone was talking about fintechs. BNPL was the buzzword. Forget about government-owned banks. These BNPLs in 2020, post-COVID, were supposed to kill the private banks also and take away the business. Now nobody is talking about BNPL. That word is forgotten. And now and the reason is because fintechs were doing supremely well worldwide. There weren't many listed fintechs then in India, but they were doing supremely well. Klarna or some such BNPL company, Swedish or something, it is like private equity valuations of north of $100 billion. And other companies in Brazil and elsewhere, there was some, I think, news item about Warren Buffett investing in one of those fintechs. So it all just became a real, narrative that fintechs are going to take away business from the brick and mortar. Because it's the recency bias of investors. And I don't mean, again, the end investors, but even fund managers and analysts are all susceptible to it. Now, for them, there was a massive long 10-year time period or 11-year time period that HDFC Bank outperformed. And now 2 years have been terrible years for HDFC Bank compared to the public sector banks. In 21, HDFC Bank underperformed by 41%, and at 22, 60%. And over a 3-year period, HDFC Bank is underperforming by 50%. Obviously, this also contributes to our underperformance. As I'm highlighting, we are one of our top holdings is HDFC Bank, and we don't own any government-owned banks. Now, over time, HDFC Bank has always been a very good sized holding for us and has delivered fantastic return. Last 2 years, it's been problematic. Now, should we jump over from year to year? I don't believe that way any money can be made. Like you see on this graph, every time there is this red zone, people would have the same question in their mind. Is it something that structurally changed and the government-owned companies would now continue to do well forever? I think as long as they're government-owned companies and management is controlled by the government, I'm not talking about just in India. We have an EM fund. We have invested and looked at these government-owned companies across the world from Korea to Mexico. There is a genetic problem, which is government selects the management. And as long as that is true, over long periods of time, because no government is permanent in a democracy or even an authoritarian regime. Hence, these companies don't deserve a multiple because the terminal value is highly suspect. And hence, while this has been the longest time period, we at least don't believe this is structural. Having said that, we do mitigate risk. It's for risk mitigation why we have 60% in large caps, right? We are not zero large caps, even though we believe alpha is more in mid and small. Similarly, as the weight of these companies have gone up in the benchmark, so this segment of the market, poorly governed segments of the market, has now become 25 to 30% of the benchmark. This was probably around 15% of the benchmark at the COVID bottom in March 2020, and has gone up substantially because this segment has outperformed. 15% underweight was tolerable, 25% underweight is not tolerable. And hence we have cherry-picked from the bad lot, if you will, or the poor governance lot to mitigate the risk. And while we don't think we can generate 8 to 10% alpha in that segment of the market, but we would still, just like in large caps, we do generate low to mid single digit of alpha. We would seek to generate, at least that kind of alpha, or 2-3% alpha. So we have invested in certain, these are just the industrial names, but there are other names as well, a couple of other names as well, like BEML is another name, which are government owned, to mitigate this risk. But are we going to be overweight government owned companies? Highly unlikely. Never say never, because the governance is an important element of our investment approach since ever. Sometimes it is true that poorly governed segments of the market would do very well, but then there would come a time period like 2018. So like there would come a time period like 2018 when the poorly governed segments of the market would do very poorly. During this time period, upward sloping line, remember, means the poorly governed segments of the market are doing poorly. So there would come this time frame. You can't, nobody, just like nobody can time the market over here. Yeah. Nobody can time the market, like get out at the top and get in at the bottom. Retail investors are good at doing the reverse because of the fear factor that plays on their mind, but nobody is shown any consistency, any skill in getting in at the bottom and getting out at the top or anywhere near. Yeah. Same way, you cannot predict that government-owned companies would do better or would do worse. You have to assume that they'll do all in line with each other. However, alpha generation potential is lower in this segment of the market, and that is the reason why we don't allocate much capital over there, because the idea is to not just avoid underperformance, but the idea is to generate alpha over time. And we've done that over a 16-year time period by allocating, even with lower allocation to government-owned companies. I think the worst in this graph, I forgot to mention one thing. The worst performers are not the fixed income guys, where only 1 crore has gone to 9 crores. The worst performers are actually the people who get very nervous at the bottom and exit the market, only to re-enter. So if you look at in this slide, there are investors, I'm not talking about investors on this call, but there are investors who will be sucked into the market. Many of you would have seen the Harshad Mehta scam movie. They would leverage themselves and get sucked into the market at the top and exit. So at the top, they would believe risk hai to ishq hai and all those things, that in many ways these bulls would in media would portray, and they would tend to enter at the peak, and then at the bottom they would exit. They would tend to enter close to here, because everything, and Harshad Mehta is talking about, India is as the best place in the world, and then the scam breaks out, market's gone down 50%, and then there are headlines whether the scam is 5,000 crores, 10,000 crores, 50,000 crores, whatnot, and that scares the hell out of people, and they exit. And then they come back then closer to 98, 99, 2000 time period, when there's a bull market in TMT, and again it's a new age .com and everything, and they believe the world has changed, and now equities is again structural thing, and hence, though I missed out on last many years, I will enter at the top, and again then the bubble bursts, they get scared that it was all a bubble and exit, and then it keeps repeating. 2008 bubble, when it burst, everyone was so scared of Lehman crisis. 2008 Diwali parties, you all remember, everyone was hyper scared and exited the market, because we've not even scratched the surface. Everyone was putting out targets like index would become, Sensex would become 5,000, 3,000, no end on the downside. And a year later, then once the election was over and the market hit few circuits upward, and then finally the same investor comes back. And every time in doing so, you miss out 50% to 100%. And hence your return ends up being actually oftentimes worse than the what fixed deposit would have given. And same would be the case of fund managers who try to keep chasing what segment of the market, government sector is doing well, or the other sector is doing well, or the other sector. There's no money to be made that way. You manage the risk, which we've shown to historically manage extremely well. We are not just amongst the very top performers over time in terms of return. We're also the most consistent over time. Yeah, notwithstanding last year, including last year, we are the most consistent over time. Though last year was the most negative of the years over this time, but that doesn't change the fact that we are the most consistent over time. And hence we would not be chasing, because that chasing would not result in any other. If we had a belief, if we believed that such chasing can generate alpha, we would do that. But that kind of chasing doesn't serve anyone.
Sure. Thanks, Prashant. So Manoj, quickly, a question for you on CDMOs, given that the subject to regulations, if you can just talk about the regulatory aspect governing CDMOs.
So I think, Vivek, when you talk about the regulatory aspects, I think it's a very important consideration. And given that most of the companies who works with the innovators, they do have regular inspections from their partners, I would say that until now we have seen that their regulatory standards are pretty good, and they have been able to pass most of the regulatory inspections, etc. But again, when I talk about regulatory challenges, it's not only pertaining to India. I think across the globe, whether you talk about US, whether you talk about China, a lot of companies do find these kind of regulatory issues even in the respective country. It might be just because we do track Indian companies, and people feel that Indian companies are probably have a poor regulatory track record. But that's not the case. Even companies in the US, the largest company, even Pfizer, have got a couple of time FDA observations and FDA 483 letters.
Sure, Manoj. We are almost past the time, but we couple of last questions. So Parag, one quickly for you. Can you quickly comment on the affordable housing finance companies?
Yeah, so I think it's a pretty interesting space, and it kind of, when you say affordable housing, it kind of ranges from a pure housing company at a various ticket size, as well as there are companies which give you a loan for business purpose by mortgaging your house. So I think very interesting. We own one or two companies there, which are very niche, operates in a very small ticket size and with a decade of experience. What matters in this space is core competency, because housing looks very simple, but it is not so simple when you have different ticket size and when you go actually to the self-employed category and category which don't have income proofs and all, and in this segment valuations are reached, so it have to be very, very selective. And I think there are winners here, and a right combination of strength, underwriting, and selection of customer base is something very important to make money here. Right?
Sure. Thanks, Parag. Hi, Prashant. There are a few questions on the IT sector. Just a comment on the IT sector and valuations.
So again, valuations are to be looked in the context of the prospects, and can vary. The prospects can vary from company to company. The IT sector globally, the way we think about it, if you were to the backdrop for the individual company investments, see, IT spend globally grows around 4% in dollar terms. Yeah, outsourcing grows somewhat higher because companies worldwide, Fortune 500, Fortune 2000 and beyond, they are increasingly outsourcing. So assume outsourcing grows a percentage point or thereabouts higher. Offshoring is growing somewhat faster. Which is, so one can outsource in US to companies within US, but one can also outsource to low cost or high value locations like India. So as per NASSCOM projections, Indian IT industry is expected to grow about 7 to 8% over time. Within that, these are dollar terms, remember, which is a big mistake, that people think of this 7 to 8% growth and they look at other companies which are in rupee terms, say consumer staples or consumer discretionary, which are growing 10, 12%, but those are rupee terms. So when you convert dollar to rupee over extended period of time, rupee has depreciated by 3.5 to 4%. So what is 7, 8% translates to 11, 12% in rupee terms over time. It doesn't come year after year, every year, sometimes more, sometimes like last year, sometimes less like this year. So we think that the industry would likely grow low double digit in rupee terms, 10 to 11%. Now within that, just like in financials, 12 to 15 years ago, you could have said, okay, NBFCs would grow at 15%. But there are many NBFCs which have gone bankrupt and zero and business shut down. And then you have NBFCs like Bajaj Finance, which have compounded at 30% because of fantastic, superb execution, super normal execution. Same way in IT services, we look for companies that have executed extraordinarily. And these companies like Coforge, as an example, has outgrown most companies in the IT sector over the last several years. This year also remains to be seen, but we do expect them to be amongst the top quartile or better in terms of growth delivery. So the ROICs in the industry are very good, unless you are doing any accounting, jugglery, which the team has over the last many years done a superb job at avoiding companies with poor governance and accounting, and that's the reason why in 2018 the performance was as strong as it was. So unless you're doing accounting jugglery, the business can generate strong returns. And within that, we look for companies that are scaling up faster by gaining market share. Examples like Coforge, which also you saw has been one of the top contributor to performance. And we invest at valuations that we believe for companies in context of these are attractive. So right now, something like Coforge, Persistent, they are trading at low to mid 20s cash flow multiple, the OpCo multiple. We haven't gone through all that today, but as you might recollect, the way we value companies are on basis of our excess ROIC or OpCo multiple. So the market is trading at about 30 times right now. Sensex multiple is about 30 times on that metric, whereas these IT companies are all trading below that. So I believe the valuations are attractive. Yes, the near term demand environment and outlook is mixed or difficult to predict because of the potential risk of slowdown in US. And that is possibly one of the reasons why there is opportunity in some of these names at the valuations that they're trading at. Maybe we can do a rapid fire on some of the other names, on some of the other questions if we still have time.
Yeah, maybe a couple more, Prashant. So very quickly, just your view.
I see a question on InfoEdge. The ROE
Yeah.
and ROC is below 5%, and market cap to sales is more than 25, and so on. So on what basis you have this stock in the portfolio? So remember, what you have to look at is what is sustainable ROE, ROIC, and all in a given year or in a given quarter. Because of certain exceptional items, the ROIC may be lower. In any business, there could be exceptional items. Listed or unlisted business, there could be exceptional items. Even some of the best companies in India, like Unilever and others, they might take some write-off sometime or the other. I don't know whether Unilever has taken or not, but that is a possibility. So InfoEdge had to write down some of its investments recently, and that's why last year or last quarter might show low ROE or ROCE, because the R is the numerator is artificially suppressed or temporarily suppressed. Otherwise, for InfoEdge, Naukri.com, which is the bread and butter, 80% of the value, they have 80% market share in the Naukri business, in the job search business. They have 60% EBITDA margin, almost infinite ROIC, because there's no capital. They take money upfront for services provided over the next 12 months. And so the ROIC there is infinite. Obviously, in certain of their businesses, they're still in the investment phase, like 99acres, Jeevan Sathi, and others. So those you do value separately. But even if you take the combination of these .com business on a sustainable basis, they've done extraordinarily well on ROIC, ROC. It's a name that we've owned since inception here at White Oak. And it was one of the top contributors, as you saw. And I have owned it at my prior firm for similar time frame as well. So it's a name that we've owned for a dozen years now, if not longer. And they are very well aware that it's an extraordinary ROIC and cash flow generating machine.
Maybe Prashant, you can talk about the global semiconductor scenario. There's a question on that.
There's a question on, please elaborate your view on the global semiconductor scenario, especially given the tension in Taiwan. So obviously, if something were to happen untoward in Taiwan, if China were to take it under one fine morning, then there is a major disruption possibility. But a lot depends on what is the reaction by US and others, whether there are sanctions or whatnot. So there would be if some such thing would happen, the prices of semiconductors, all kinds of chips and whatnot would shoot through the roof, and then there'll be a mad rush to set up, parallel capacity in Europe, in US, and everywhere else, which already has started for diversification and these are strategic investments for countries like US and in Europe, because after having seen what happened with Russia, Ukraine, they don't want to be overly dependent on Taiwan. So it's a binary thing. If that happens, there'll be a lot of disruption, inflation in prices of semiconductor, all things related to semiconductor. If it doesn't happen, then it's business as usual, which does go through ups and downs as semiconductors hardware business. And when economy slows down, like it is right now in some of the markets like US and Europe, it is going through oversupply situation in some segments of the market. But there also are many nuances. Our AI related chips and equipment, they are surging, and that's why you have names like Nvidia. Even in a semicon slowdown time period, Nvidia is up more than 200% in the US, because they're at the heart of the this AI related and graphics related phenomenon.
Thanks, Prashant. I think we are now out of time, and we'll end today's webinar here. Just like to thank everybody.
I want to thank all of you who endured the last 2+ hours or nearly 2 hours and joined today. Any follow-up questions, please do reach out, and hopefully many of you attended last time and have, upon your request, received the copy of One Up Wall Street. If you haven't, do let us know. The copy of that session received a lot of positive feedback. If any one of you would like to hear that again, there would be a link available that our team can forward to you. Thank you all once again for your investment, for your engagement, and for participating today. Thanks much.